Okay, this is part two of a presentation that I've already started, all about interest rates. So, if you are interested in what interest rates, like how interest rates are actually created, how they're decided upon, all the sort of tricks and games that lenders will play in order to ensure that you're on the highest interest rate possible, then go and check that video. This goes a bit further into that as well, and is probably more relevant if you're just interested to know what happens once you actually settle on your home loan. So, without further ado, what happens when you settle? So, number one, your rate is going to get pushed up in the first 6 to 18 months, usually by 20 or 30 points. Like almost guaranteed. I've never, or very, very rarely known that not to be true. And the most obvious question is, and you'll actually see when you look at, if you've had a home loan for anything longer than a year or so, you'll always be seeming to find better interest rates available. Like, we will get you as at Voyage, and most brokers will do this, we'll get you on a really good interest rate. But then you'll go and see 12 months later, like even the same lender that you're with is offering better interest rates. And there always seems to be better rates available on the market. So you're going to ask why that is. The reason that is because the actual market rate, i.e., the lenders, the rate that most lenders can actually afford, is different to the rate that you start out on. So this is really important that you understand the difference between market rates and acquisition rates. The rate that we set you up on is called an acquisition rate. The rate that is sustainable for most lenders over the long term is called a market rate. So the rates that you get, you might remember years ago you'd be offered, like, there were honeymoon rates available. We've sort of, like, that term honeymoon rate doesn't really exist anymore, but you've got to think of basically any loan that you get as almost like a honeymoon rate that is going to get pushed up to the actual market rate, which is the long-term stabilizing rate that allows the banks to be profitable and for the lender, for you to have a decent long-term good saving on your interest rate. They're different rates. It's not sustainable over the long term. So as long as your rate is within 20 to 30 points of what's advertised by pretty much any lender, your rate is really, over the long term, basically as good as it's going to get. Now, it's our job as brokers to ensure that your rate is within that band over the long term. And this is why refinancing is often a fool's game. It's an illusion of savings. Every 12 to 18 months, it's our job as brokers, if you're with us, to ensure that your interest rate is at least on the market rate. You will often see acquisition rates out in the market, and it's not uncommon for us to get called or communicated with by our clients to say, hey, my associate's got this rate, my friend or family has this rate, it's like typically 20 to 30 points below what I've got, can we get that rate? And now, because I explain this all the time, hopefully you're watching this video and you're like, oh, I now understand why. It would also help if you've got another 20 minutes to watch the first video as well. It'll explain a little bit more about the mechanisms by which lenders can actually set rates. So refinancing for like 20 points better, and I've got something that I'm going to show you probably at the end of this presentation. I'll go for another 10 minutes and then I'll show you a calculation that shows that refinancing for 20 points better really won't do you any good over even the medium to long term. But let's assume that you get a permanent discount off the reference rate. Now, I've explained what that is in the first video, so you will have to go back and reference that if you want to understand exactly what that means. But that reference rate is going to get pushed up every 6 months or so. And the reason that we know this is because every lender, especially the larger lenders, are going to keep on offering larger and larger discounts off the standard variable rate. So typically with one of the larger lenders, just to re-explain, if you didn't watch the first video, you've got the rate that you get offered with one of the larger lenders is going to be a rate that includes a discount of what they call a variable rate. So in the last video, I used an example of Westpac. I think the rate, the standard variable rate or the reference rate was sitting at around 8.93%. And then the rates that were offered on their website were sitting at 1.74% below that. So that was like the discount that you got. Now, had you come to us, we can usually get a bigger discount than what's actually offered on the website, for reasons that I don't really fully understand. I don't know why lenders don't just put their best rates available online. In fact, I do know, because a lot of people don't check. And so they're able to they can actually get people on higher interest rates if people don't do the research and actually check these things. But when I was, just to get back to the point, when I first started broking over 10 years ago, I remember, we used to do loans for, let's say, $1 million. We would apply for pricing at the major lenders through their pricing tools. And I remember getting discounts for 1%, like variable discounts off the variable rate of 1%. ANZ was an example, and that was like brag to the office worthy that you were able to get a 1% discount off the standard variable rate for this client, which meant, of course, that the client got a cheaper interest rate. Now discounts are actually creeping up towards 3%. So what lenders are doing is, in the background, once you actually settle, the interest rates are starting to creep up. They're having to offer larger and larger discounts off the standard variable rate or off the reference rate in order to make their rates actually seem competitive. So, and those interest rates, those discounts are going to keep on increasing over time because that's been the trend over the last 10 years. So refinancing for 10 to 30 points is actually going to cost you money unless you've got a rebate involved, and it's going to leave you in the same position that you were in a year's time. So looking at interest rates and thinking, I can refinance for 10 points or 20 points or 30 points better. Unless you've got a multi-million-dollar loan, I can guarantee you're actually not saving any money. You're actually costing money. And the other caveat there is unless there is a rebate involved. Now, I've got 3 more slides on this, and then I'm actually going to show you the calculation that shows you why that's the case. Okay, so what happens if your rate isn't actually what if your rate is not within 20 or 30 points of that, the best acquisition rate that you can find online? It's important for you to know that lenders genuinely do not care about you. It's all just a numbers game for them. You being a customer for 15 years means absolutely nothing, and I've got a story to tell you about that shortly. They are only going to offer existing clients good market rates if it's in their best interests. So if you're with Voyage, every single year, we're going to be approaching a lender and saying, the lender that you're with, and saying, hey, our client's rate has actually crept up over time. We need it to be brought back down to the market rate. We're not going to be able to get back down to acquisition rates. You need to know that now, but at least back down to the market rate. So the process that we'll follow, and you can follow this yourself. If you don't have your loan with Voyage, then obviously you can do this yourself as well. We'll do this for you if you are with Voyage, and most good quality brokers will. Number 1 is to ask your lender for a better rate. That's number 1. Most of the time, unless your rate's really atrociously bad, the lender is going to say probably not. Number 2 is going to then be to ask for the discharge form and potentially submit that discharge form. So the discharge form is a form that you'll submit to the lender to actually physically tell them you need to start preparing for this loan to exit. We're going to take it somewhere else. And sometimes that's enough for them to ensure that their retention teams, the bank's retention teams, give you a call and say, hey, you're actually thinking about leaving us? Oh, we can actually offer you a better interest rate. What do you think about this? And usually, hopefully, it should be within 30 points of the best rate that you can find. So it is actually the market rate. And that's really as good as we're going to get. That's what we want. It's funny, like in the last couple of years, lenders have suddenly woken up to the fact that keeping clients or customers on the market rate is much better than just losing them. So the last, the first 10 years or so of my broking career, lenders didn't care if they lost clients or customers at all. They was like, yeah, we're not going to offer you anything better. And then so for us, it was easy. It's like, great, lender's not going to help. Let's take you elsewhere. Now the market is tightening up a lot. A lot of lenders seem to have finally realized that keeping clients is much better and much cheaper and much more profitable than always trying to market for new clients. So typically the first process for us, if you're brand new to us, is for us to actually to submit a discharge form before we do any work, just to make 100% sure that lender is not going to suddenly turn around at the last minute after we've done a heap of work and then match the rates that we're going to get you elsewhere. One story that I remember from the first couple of years of my career is going to a professional development day with Aussie Home Loans. And the CBA, the Commonwealth Bank state manager, stood up. He was due to present. He was speaking on stage. He was facing a lot of flack from brokers because CBA had just introduced refinance rebates, and they were offering new clients really good rates. So new to bank customers offering really, really good rates. Existing customers, they weren't touching at all. They didn't care. So they were offering rates to new clients or customers 30, 40, 50, 60, 70 points below what we as brokers were able to get existing Commonwealth Bank clients. And he stood on stage and said, we don't care. We are in like a growth phase, an acquisition phase. He said, we know that there's going to be some runoff in the back book. That's part of doing business. We don't care. We're focused on getting more clients into the bank. And for us as brokers, we're like, that's the attitude that these bankers sitting in their office towers have. They just don't care. There was no loyalty, no consideration of existing clients. They just did not care. And so that attitude may have shifted a little bit over the last 10 years, but really it's mostly the same. They just don't care. All they're looking at is like their KPIs. I don't care about anything else. All right, so another question that we often get is, should we fix? This is probably better, would have been better in the first part of this presentation, but really, really briefly, interest rates games aren't played with fixed rates at all. So you typically can't ask for a discount off a fixed rate. What you see and what's advertised is what you get. It's what happens after the fixed rate ends that actually matters. So remember, like the golden rule in lending is that banks don't set rates to lose money. Typically, if they're setting a fixed interest rate over the next 2 or 3 years that looks really attractive, there's a reason that they're doing that. They haven't just plucked a number out of the air. They've looked at the economy. They've looked at what they have forecast to happen. They've got like entire economics departments dedicated to figuring out what interest rates are going to do. They've set interest rates very, very intentionally because they believe that they're going to be able to make money off them. So apart from a period over COVID where fixed rates were kept artificially low through government lending to banks, usually clients don't end up in a better position. It's really a roll of the dice. Sometimes you win, but it's not because you're smart. It's because something in the bank's forecasting has gone wrong. That's typically the case. Like over COVID, banks were basically, the government was guaranteeing really low interest rates via like a massive release of funds to banks. Apart from that, and so you could lock in for 1.9% for 4 years and do phenomenally well, but that's the only time I've ever seen fixed rates really work out for everyone. Anytime other than that, it's really just a roll of the dice, and the lender, the bank, Commonwealth Bank, Westpac, etc., they're the house, they've got the edge, they know what they're doing, and we don't. So remember, lenders don't just set fixed rates with the dartboard, they've got vast resources to determine exactly where to set them to maximize uptake, because they want to make them look attractive, but they also want to make profit. All right, our approach to interest rates. So unless you've got exceptional circumstances, a variable rate within 20 to 30 points is really about as good as it gets. We would only fix if it makes sense in your circumstances, and typically we're going to email you at a very minimum each year to ensure that your rates are at actual market rates. And hopefully you understand now that when you see your colleague or someone else getting better interest rates, this goes into part 1 of the presentation as well. You'll actually understand why. So I'm going to stop there, and then I'm going to come back and show you just the calculation that shows that 20 or 30 points for most people is actually not going to move the dial at all, or at least even backwards in terms of your financial position. All right, let's have a look at this. So this is just a little calculation that I put together because some people have pushed back on me and said, hey, are you really sure? Like 20 or 30 points discount sounds good to me. This shows absolutely that it's not. And the only reason that we might look at refinancing for a 20 or 30 point, and by 20 or 30 point, what I mean by that is the difference between a market rate of, let's say, 6.3%, and then, or as you can see here, 6.25%, and then an acquisition rate of 6%. So the scenario here is that you would be on a 6.25% rate. That's the market rate, sustainable over the long term. But you hear of friends or colleagues, or you see online, interest rate may be sitting at around 6%. So typically 0.25, 0.3% below the market. Now, let's actually play this out. So let's assume that you've got a loan amount of $700,000 and you're on 6.25%. What you could be on, though, is the acquisition rate of 6%. So if we have a look at the monthly interest on these amounts, you can see that we've got monthly interest of $3,645 for the interest rate at 6.25%, and then a monthly interest of $3,500 for the acquisition rate of 6%. So let's assume in January you decide, you know what, this market rate sucks. I'm actually going to go to the acquisition rate. I'm going to refinance for 6%. Now, so the interest savings at month 1, you're actually going to save $145. Awesome. There's some other bits and pieces that we need to take into consideration, though. So number 1, there's going to be a cost to switch, and I've probably underestimated this because these costs are going up. But when you refinance, there's some money that you need to pay to the government. You need to deregister and re-register the mortgage, and that's going to actually come in at, I think, over $700 now, but let's assume $700. There's also going to be an annual fee. So typically when you refinance, again, not all lenders have the annual fee. Maybe you're not on a package with an annual fee. Let's assume that in this case you are. We've got an annual fee for the existing lender of $395. Let's assume you've actually paid this, because we're not going to be refinancing exactly 1 year after you've settled. Usually it's like 1.5 years, maybe 2.5 years after you've settled on the initial rate. And so sometime in the previous couple of months, you have actually paid $395, and that $395, again, that's a typical sort of annual package fee, but that amount is just going to disappear. You're not going to be able to recoup, the amount that you haven't, the months that you haven't paid for that $395. It's just a cost that you've borne and then not actually gotten any use out of. So let's assume that a couple of months prior, you've paid the existing fee, the annual fee for the existing lender of $395. Let's assume that we're paying an annual fee for the new lender as well of $395. Now we can play around with this. We can actually take these numbers out and you'll see that the figures basically work out the same. But here you can see that we've saved $145, but we've actually cost ourselves that amount there, $1,400-ish. And so over the course of the first month, we're actually down $1,344. Now in month 2, we're actually making the same savings. So $145, maybe slightly less because we've paid the loan amount down slightly. So the interest savings come down by a couple of cents. But now from this deficit, we're starting to eat this deficit back up. So month 2, awesome. The deficit becomes less, becomes less, becomes less, becomes less, becomes less. What have we hit here? June, July, August. Now, this might come September, October, November. I'm not exactly sure when, but at some point, the loan that you've gone on to is going to increase because this acquisition rate is not sustainable over the long term for the lender. So let's say in September, they're going to put your loans up out of order, out of context, not in line with the RBA. They're going to put it up basically back to what you've got. And this might happen in December, January, whatever. Like we can play around with some variables, but the results are the same. 6.25%, awesome. So all of a sudden, interest savings are at zero because we're paying exactly the same interest cost on the amount that we've got owing. So all of a sudden, we're stranded at $327. Now let's assume that we keep on going. Quite often what will happen is within about a year or a year and a half, the lender that we've moved to will actually have put their interest rates up again. So it's up to us as brokers to ensure that if the acquisition rate is still sitting at 6%, the market rate's still sitting at 6.25%, that we jump on this gap as quickly as we can and ensure that your interest rate has dropped back down to 6.25. But in this case, we're actually now paying more. So all of a sudden we're going backwards again. We've got the annual fee for the existing lender, that's come around again, and then all of a sudden we've gone backwards. So let's assume that this has played out and you figure out in maybe a year and a half-ish after you settle, you actually check your interest rates again and go, holy crap, we're on 6.5%. That's really, really uncompetitive. What a terrible rate. I'm going to start looking around and see what else is available to me. And then you have a look and you go, there's an acquisition rate available at 6%. Maybe we'll actually go to that. Now, we would actually ideally put your rate back down to the market rate, so it goes back down to 6.25%. But let's assume you go, no, I'm going to refinance. Like a year and a half later, 6.5% is too high. I can see some really good rates available on the market for 6%. I'm going to refinance to 6%. And so you refinance, and then what have we done? All we've done is we've incurred a cost to switch of $700. We've incurred the annual fee to the existing lender, to the new lender, a new $395. And then all of a sudden you can see we're now down from where we were at the very beginning, $1,710. And the whole cycle effectively then repeats itself. So even if we play around with some of these figures, like you might say, well, what if we change the loan balance what if we change it to $1 million? You can see we're pretty much in the same position. So market rate 6.25%, we refinance at 6%, we're down here. Then all of a sudden, sort of by the end-ish of the year, we're sort of up a little bit until the new lender equalizes and gets you off that acquisition rate, puts you back on the market rate. We might be up like $170. Then, there's another unscheduled rates increase for that new lender. And again, the market rate lender might do the same thing, but probably not, because once we've got you back on the market rate, they typically won't try and push you up too much higher after that. They really need to get you off the acquisition rate as quickly as they can. So all of a sudden you're going backwards and again, you start again. So you're like, my rate's really bad. I'm going to actually refinance to a better, this new rate that I've just seen online, and you just go backwards again. Same if we put in less. let's say, I don't know, 400,000. No, not 4 million. 1, 2, 3, 4, 5. We're down 1,400 to begin with. We never really make that up at all. If we've got money in offset, like the more money that we've got in offset, the worse this actually becomes, and it makes less and less sense to refinance. So again, we can play around with the numbers, we can play around with the annual fees and the existing fees, but you'll see, like, even if we take these fees out and we put this up to maybe like, back up to 700,000, maybe even $1 million. Let's put it up to there. You can see we might only be up like maybe $1,000. And so if we're doing this over and over and over again, it just like the economics and the maths don't add up. You might save maybe $1,000 a year, but I can guarantee you there are quicker ways. There are quick ways for you to earn or save $1,000 rather than going through this whole refinancing process every year or every 18 months. And what I would, again, the only caveat to this is if there's a refinance rebate involved, and we know that we're going to incur roughly $1,000 in refinance cost, but that's going to be reimbursed by a couple of grand, then maybe the economics starts to make sense. But otherwise, even if you've got $1 million loan, we're going to be up by a little bit of money, maybe $1,000 over the course of the year. Like, I can guarantee you, after talking to you for 5 minutes and having a look through your stuff, we can find a better way to save $1,000 rather than going through this entire process. All right, so hopefully that makes sense. And that's it for this video. Thank you very much for watching. And if you've got any questions, please don't hesitate to ask your broker or book a chat and we can talk you through it. Thanks.